Welcome back to Pesa Forever channel. If you are watching this, you are likely looking at your investment portfolio today, here in February 2026, and feeling a complex mix of emotions. We have just witnessed one of the most volatile periods in the history of the Indian precious metals market. You have seen silver prices touch parabolic highs, hitting levels we previously only debated in theoretical models. And you have seen the sharp, breathless corrections that followed immediately after the union budget. But here is the core issue we need to address today. Making a profit on paper is a straightforward arithmetic exercise. Actually realizing that profit in your bank account without losing a significant percentage of it to hidden charges, new tax mandates, and structural market inefficiencies is an entirely different challenge. Today we are conducting a comprehensive analysis of the exit strategy. This is not about accumulation, this is about capitalization. We are going to analyze the liquidity traps inherent in the physical market, the implications of the new 12.5% tax reality, the technical dangers lurking in MCX options contracts, and why institutional capital is rotating assets right now. There is a considerable amount of noise in the financial media. Let us cut through it with hard data and clear analysis. The liquidity trap in physical silver. Let us begin with the most tangible friction point for retail investors holding physical bars or coins. This is the phenomenon we call the liquidity trap. You might see a certain price on your trading application or television screen, often referred to as the spot price. However, attempting to liquidate physical silver at that specific price point in the current market environment reveals a stark disparity. During periods of extreme volatility, which defined the start of 2026, local jewelers and bullion dealers often suspend buybacks at the spot rate. This is a defensive measure to protect their operating margins against further downside risk. If you walk into a dealership with a 1 kilogram bar today, the counter-offer will likely be significantly lower than the market rate you saw online. Dealers apply what are known as melting charges. In stable markets, these are negligible. Currently, however, market reports indicate deductions ranging from 10 to 20%. Therefore, if silver is trading at a premium on the exchange, the physical holder is not necessarily capturing it. You are effectively paying a heavy exit fee to convert metal into liquidity. This is the friction cost of physical ownership that is rarely discussed during the accumulation phase of a bull market. The economic reality is that the price on the screen is not the price in the hand. The new 12.5% tax rule. We must move immediately to the regulatory landscape, specifically the alterations introduced in the Union Budget 2026. This is the most critical factor for your net profit calculation. The government has streamlined the definition of long-term capital gains for commodities, but it comes with a caveat that alters the math for long-term holders. The new rule states that if you have held your silver, whether in physical form or essentially as a long-term asset for more than 24 months, your gains are now taxed at a flat rate of 12.5%. On the surface, this appears lower than the previous 20% rate. However, the critical change is the removal of the indexation benefit. Previously, investors could adjust their purchase price to account for inflation, which significantly lowered the taxable profit figure. That mechanism has been removed. You are now liable to pay that flat 12.5% on the absolute difference between your buying and selling price. While the headline rate is lower, the taxable base is larger. When calculating your potential exit, you cannot look at gross profit. You must deduct this tax liability immediately to understand your real spendable liquidity. The gold-silver ratio warning signal. Now, let us examine a global macro indicator that professional traders and institutional desks monitor closely. This is the gold-silver ratio. Simply put, this ratio measures how many ounces of silver it takes to purchase one single ounce of gold. Historically, this ratio oscillates within a defined range. In early 2026, we observed this ratio drop below 50 to 1. For the uninitiated, this is a significant statistical deviation. When the ratio compresses to this level, it implies that silver has become historically expensive or overvalued relative to gold. Empirical data from previous cycles suggests that when the ratio hits these extremes, a mean reversion is often imminent. This sub-50 level is viewed by many market analysts as a signal for asset rotation. Institutional strategy often involves selling the overperforming asset, in this case silver, and moving capital into the underperforming asset, which is gold. If you are holding silver with the expectation that it will continue to outperform gold from these levels, you are betting against historical probability. The ratio provides a quantitative argument that the aggressive phase of the silver rally is concluding. Import duty cut impact. We must also contextualize the domestic price drop against the backdrop of the import duty changes. The Budget 2026 reduced the customs duty on silver from 6% to 5%. While a 1% reduction may appear nominal to the casual observer, in the commodities market this is a structural shift. Domestic silver prices in India are derived from international prices plus the import duty and the currency exchange rate. When the duty was reduced to 5%, the landed cost of silver in India adjusted downwards immediately. This caused an instant repricing of inventory across the nation. Investors holding silver and waiting for a rebound to pre-budget highs must understand that the baseline has shifted. The domestic value has structurally dropped because the tax component embedded in the price has been reduced. Waiting for the price to recover to old highs simply based on hope ignores the fact that the structural floor is now mathematically lower. MCX options devolution danger. For the traders operating in the derivatives market, specifically those using MCX options, there is a technical risk that requires urgent attention. This is the risk of devolution. Many retail traders purchase options because of the low capital requirement. However, if you are holding in-the-money silver options and you hold them until the tender or expiry date, these positions do not cash settle in the way an index option might. They devolve into futures contracts. This means a relatively small options premium payment suddenly converts into a massive futures contract obligation. This requires a margin blocked in your account that runs into lakhs of rupees. If that margin is not available in your account, the penalties are severe and immediate. The educational takeaway here is precise. If you are trading options, the standard practice is to square off positions well before the tender period commences. Holding in-the-money options through expiry can result in a margin call that far exceeds the initial capital deployed for the trade. The principal first strategy. How does an investor process this data into a coherent approach? One method discussed frequently in risk management circles is the principal first strategy. Given that many investors entered the silver market in 2024 and may be sitting on paper profits exceeding 50%, this strategy suggests selling a specific quantity of silver, exactly enough to recover the initial capital investment. This is often referred to as taking the principal off the table. By doing this, the cash deployed is returned to the bank or deployed into a stabilizing asset. The remaining silver in the portfolio effectively becomes a risk-free holding. If the market corrects further, the investor has lost only paper profits, not their original savings. If the market rallies, they maintain exposure. This strategy is designed to neutralize the emotional stress of volatility by securing the base capital first. Digital silver spread costs. We must also address the segment of the market invested in digital silver through payment applications. There is a misconception that this is the most liquid form of ownership. While it is convenient, the cost structure is often prohibitive for short-term exits. Investors need to examine the buy-sell spread. On most major platforms, the difference between the buying price and the selling price at any given second is between 3 to 5%. Additionally, the 3% GST paid at the time of purchase is a sunk cost that is not recoverable on sale. Therefore, when you combine the spread and the tax, an investor effectively starts their position with a deficit of roughly 8%. The price of silver must rise by this amount just to break even. Therefore, for those considering a quick exit in February 2026, it is vital to calculate if the market rise has actually cleared this 8% hurdle, or if the exit will result in a net loss despite the bullish chart. The 75-25 rebalancing rule. In light of the volatility and the gold-silver ratio we discussed, many financial analysts are currently advocating for a portfolio rebalancing rule known as the 75-25 split. For investors heavily allocated to precious metals, this approach suggests shifting the portfolio weight to 75% gold and reducing silver exposure to 25%. The rationale is grounded in the different behaviors of the two metals. Gold is historically less volatile and acts as a stabilizer during economic deceleration. Silver, being an industrial metal, carries higher beta and volatility. By limiting silver to 25%, the portfolio retains exposure to industrial upside, but is insulated from the severe drawdowns that silver often experiences during market corrections. ETF versus physical holding periods. Finally, we must highlight a tax arbitrage opportunity that exists depending on the vehicle of ownership. There is a distinct difference in holding periods for tax classification between physical silver and silver ETFs. Under the current framework, physical silver requires a holding period of 24 months to qualify as a long-term asset, eligible for the 12.5% rate. If sold before this period, gains are added to income and taxed at the slab rate. In contrast, silver ETFs are considered long-term assets after a holding period of just 12 months. This offers a significant advantage for those who entered the market in early 2025. ETF investors can exit now with a tax-efficient outcome, whereas physical holders from the same period would face a higher tax burden if they sold today. This structural difference makes the ETF a more flexible vehicle for medium-term exits. Myth busting. To round out this analysis, let us correct 3 common misconceptions prevalent in the Indian market. First is the belief that a local jeweler will buy back a silver coin at the newspaper rate.
The data shows this is incorrect. Between the loss of the GST component, making charges, and purity deductions, the realizable value is typically 85 to 90% of the market rate. Second is the myth that silver always moves in lockstep with gold. While they are correlated, silver is a high beta asset. In the recent correction of February 2026, while gold corrected by approximately 12%, data indicates silver corrected by nearly 36%. The magnitude of the move is significantly different. Third is the assumption that one can sell a silver ETF instantly at any time. While generally true, during periods of flash crashes or extreme stress, ETFs can suffer from tracking errors or widened bid-ask spreads. In a crashing market, the price on the screen may not be immediately available to sellers using market orders. Conclusion. The landscape of February 2026 offers a clear lesson. The easy accumulation phase has passed, and the market has transitioned into a phase defined by high volatility, tax considerations, and liquidity constraints. Rational decision-making requires looking beyond the headline price. It involves calculating the net realizable value after melting charges, understanding the new tax implications without indexation, and recognizing the signals sent by the gold-silver ratio. Whether one chooses to protect principal or rebalance toward gold, the focus must remain on preserving the wealth that has been generated. Thank you for your time and attention to these financial details.
Disclaimer. This video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.